By the end of next year, 3 out of every 4 mortgages in Canada are scheduled for renewal. Think about that for a second. It's not a slow trickle, it's a tsunami of deadlines hitting all at once. Imagine this, you're sitting in your living room, the same home where your kids grew up, and a piece of paper arrives. It tells you that your $2,000 monthly payment is now $3,000. You didn't move. You didn't upgrade the kitchen. The only thing that changed was the calendar flipping over. Now, on top of that punch to the gut, you're already navigating a weak economy, a job market that feels tighter than ever, and a government that seems to have completely forgotten the pain being felt at home. That isn't a scenario, that's the cold, hard reality facing thousands of Canadian families. The terms are set, the contracts are signed, and the clock is ticking down on the biggest financial shock many of us will ever face. The impact of this isn't just a bruised budget for homeowners, it's a crack running through the foundation of the entire housing system. The shockwave is coming, and in this video, we're breaking down exactly why this happened, what those crushing payments look like, the hidden risks, and most importantly, the only options you have left to protect your family and your future. If you feel the anxiety building just listening to this, and you want raw, unfiltered truth about the Canadian economy and your money, because the mainstream media is already sugarcoating this, then hit that subscribe button right now. We need to stick together to navigate this. Do it. Remember 2020? That fleeting, fragile time when mortgage rates dipped to almost unbelievable lows, some saw rates as low as 1.5%. It felt like financial liberation. Millions of Canadians, myself included, locked in those rock-bottom terms, believing we'd solved the equation of homeownership. We weren't getting a great deal, we were being set up for a trap. Now, the bill for that cheap money is coming due, and it's being served to everyone at the exact same time. We are facing a historically unprecedented concentration of renewals. This isn't just the normal ebb and flow of the market, this is a mortgage cliff. Now, those great deals are expiring, and people are renewing at rates trending towards 5% or more. Take that $500,000 mortgage at 1.8%, your payment was just over $2,000. Today, that same debt is demanding nearly $3,000 from you every single month. That is an $800 to $1,000 monthly increase for the exact same four walls, the same worn carpet, the same view out the window. You didn't receive an upgrade, a renovation, or an ounce of extra value. You're simply paying $1,000 a month more just to stay in place. This isn't inflation. This is a tax on stability. The math doesn't lie, but the real pain is the betrayal of that low-rate dream. The amount of families facing this simultaneous financial execution is what makes this a national crisis, not just a personal budgeting issue. We all signed up for the ride, but none of us knew the price of the ticket home. The defense against this shock was supposed to be the stress test, right? We were all told we had to prove we could afford payments at higher rates, up to 5.25% or more, creating this mythical safety buffer. You passed the test back then. You were approved. You thought you were safe. But that test was based on a lie, it was based on your income and expenses in the world of 2020. The world we live in today has eaten away that buffer like rust on steel. Since you passed that test, inflation has run rampant, pushing the overall cost of living up by roughly 15%. Think about your weekly grocery bill. It's up over 20%. That's 20% less money available to absorb your mortgage increase. It's a silent drain on your survival funds. The situation with wages is even more infuriating. On paper, our wages are up, but once you factor in the brutal reality of inflation, the purchasing power of your paycheck is actually less than it was when you took out that mortgage. You're bringing home a bigger number, but that number buys you less gas, fewer groceries, and definitely no financial breathing room. What was supposed to be a protective buffer has been completely vaporized by the skyrocketing cost of life itself. So, now, families are walking into these renewals with their budgets already shredded, having to find another $1,000 a month just to break even. The stress test wasn't a protection, it was an illusion that has now left the majority of Canadian homeowners walking directly into a financial firing line with no armor left. Now, let's talk about the small group of people whose situation is not just bad, but verging on catastrophic. I'm talking about the borrowers who chose a variable mortgage but with a fixed payment. It seemed smart at the time. You got the low rate, and your monthly payment stayed the same. But here is the devastating truth: as interest rates kept climbing, more and more of your fixed payment went toward interest and less toward the principal. Many of you have already hit what's called the trigger rate, where 100% of your money is disappearing into interest alone. It's like pouring water into a leaky bucket. You're paying thousands of dollars every month and seeing no reduction in your actual debt. This has led to the terrifying financial reality known as negative amortization. This means that some people actually owe more money today than they did a few years ago. Think about the emotional toll of that. You've been paying your bill faithfully every single month for 4 years, making sacrifices, budgeting tight, believing you were chipping away at your debt, only to find out you've been running on a financial treadmill that was secretly moving backward. The claims are that the worst has yet to be felt, as the majority of these renewals are slated for 2026, but the early signals are flashing red. In British Columbia, missed mortgage payments have jumped over 60% since the pandemic. Families are starting to drown right now. This is not fear-mongering, these are the raw numbers proving that the pressure cooker has exploded for some, and the rest of us are simply waiting for our turn. The truth is, for this particular group, the mortgage wasn't a path to ownership, it was a slow-moving, financial execution. The problem is that this isn't contained to individual households, it's a toxic poison being pumped into the entire real estate market. When a family is forced to face an $800 to $1,000 jump in their essential monthly costs, they only have a few options, and one of them is the forced, painful decision to sell. They didn't want to leave, but the bank gave them no choice. Meanwhile, real estate investors, the people who bought properties when money was cheap, are seeing their cash flow eaten alive as renewals devour their profit margins. They, too, are going to be forced to offload those properties. When forced sellers flood the market, it creates an avalanche of supply, putting crushing downward pressure on prices. Buyers, feeling the tension, are paralyzed, sitting on the sidelines, waiting for rates to fall or prices to crash. It's a devastating cycle where no one can win. But here's the ultimate confirmation that the system is breaking: look at the banks. The big banks are not just idly watching. They are tightening their new approval criteria, pulling back on home equity lines of credit, and most tellingly, they are setting massive amounts of capital aside for what they call loss provisions. In simple, brutally honest terms, the banks are budgeting and expecting a portion of Canadians to default on their mortgages. They are anticipating failure, and they are preparing their own financial shield against the destruction. The people who lent the money are already resigned to the reality that some of you will lose your homes. This isn't theoretical economics. This is the domino effect of the cheap money era finally hitting its wall, and the consequences will be felt by every single person who thought Canadian real estate was an untouchable investment. I know this all sounds like an absolute scenario of doom and gloom, but that is precisely why we must act now. If your renewal is coming this year or next, you cannot afford to sit and wait for that piece of paper to arrive. Your biggest advantage is time, and my most critical recommendation is to start your defense today. Book a free discovery call with a mortgage broker right now, because the earlier you start, the more options you have to construct your financial shield. You have choices that, when combined, can create a solid, life-saving strategy. Instead of walking into that massive, budget-breaking payment shock, some people are choosing to extend their amortization period back up to 25 or even 30 years. Yes, you will pay more interest over the total life of the loan, but this immediately softens the monthly burden, it restores your essential cash flow. You can use that temporary relief to rebuild your savings and wait for rates to drop in a few years, at which point you can always shorten the amortization again. The second, more aggressive option is to look at your high-interest debt, credit cards, lines of credit, and, if you qualify, roll that debt into your mortgage. That can potentially cut hundreds of dollars of brutal monthly overhead and consolidate it into a single, lower-interest payment. You are essentially taking back control of your high-interest obligations. The cool thing about being in the finance space is we see the options that families who feel hopeless can still access. We can help restructure your financial plan into something that is truly manageable. Start early, fight hard, and you will be able to protect your home, your monthly cash flow, and ultimately, your family's financial future from the looming catastrophe. What we are witnessing is not a temporary economic downturn. It's the final, brutal price tag for the collective party we threw during the pandemic. The cost of free money has never been higher. It's a shock that hits deep into the emotional core of what it means to be a homeowner in Canada: security. That security is now being challenged by rising rates, shrinking wages, and the constant, crushing anxiety of bills that refuse to shrink. The next 2 years will redefine Canadian homeownership. It's not about how much you paid for the house, it's about how much you will pay to keep it. The numbers are set, the clock is running, and the wave is coming. The question is, are you ready to ride it out, or will you be swept away?